Today, let me just really quick before we get into our recap, we're going to be talking about some technicals today. We're going to get into some really interesting stuff about modern portfolio theory, things that you can use to analyze individual investments and investments as a whole. It'll be familiar to some of the terms that we've used so far, but we're going to start getting into explanations of things. So stuff like standard deviation and beta, alpha, Sharpe ratio, those sorts of things, if you've heard those talked about, we're going to get into those a little bit. I'm going to try my best to take my time with them and make sure we get through them because they can be quite confusing, especially because of just how much there is. So feel free to ask as many questions as you want. And if we don't get through all the slides today, it's no skin off my back because this is some pretty in-depth stuff to be able to work with and understand, but it is helpful. Yes. Oh, sorry. I forgot I wasn't sharing. Yes. Okay. Uh, where is need to get to my meeting, share, screen 2. Okay, there we go. I got you. That's the first time I've forgotten that, I think, ever. So, all right. Now, let's talk a bit about what we did last time. Last time we were here, we talked about how we were going to use these sort of concepts, lateral integration, vertical integration, and how we actually used these to build an example portfolio using sort of this guideline where we have roughly 40% in our first stage, 40% in our second stage, and 20% in our third, and then layering about 45% in the base, 40% in the middle, and 15 on top. Now, again, I just kind of want to reiterate that these are good guidelines to start with. So if you don't have really any idea what you're doing when it comes to building a portfolio, you could follow this and choose a couple funds, put it together. It's going to give you a really nice balanced sort of moderate risk portfolio depending on what you pick. But you can absolutely change any and all of this. If you really like index funds and you don't like giving away a lot of cost, you can make layer one a good 80 or 90% of all of your allocations if you want to, and you can bias towards those low cost investments. I do that sometimes. I recommend that a lot of people start that way. And if you have a lot of conviction, you might have more in your layer two. It really just kind of depends on how you want this portfolio to perform for you. So having a really good idea of your purpose when you start out building that portfolio, whether it's for income generation, really just sort of preservation of a nest egg's value over time, or growth for beneficiaries, can be very helpful in enlightening you how you may adjust this for your own needs. Yes.
A layer, a pyramid.
Yes. Yeah, exactly. So pretty much each stage will be here and each layer will be here. I just understand the labels are a little different, but yes, the layers are part of our pyramid. So what we landed on was a portfolio built of this. This is just kind of our examples. We had all of these short-term bonds in our stage one, some derivative income all the way up at the top here, some minimal volatility, a balanced index fund, which is always great. If you're ever unsure about how to put together allocations, you can look up funds like this, like VBIAX or AOM, or anything that is a moderate allocation or conservative allocation or aggressive allocation. And if you want to, one of the easiest ways to build a portfolio is to just look at what they're doing. You can pull up this fund. It's very inexpensive, and you'll see that they're basically just using 2 index funds inside of it, but maintaining a 60-40 balance. And then you can see, oh, how much does that allocate towards small caps or mid caps? And it can help inform you of how you might build your portfolio. So always don't be afraid to use examples. Things like target date funds are also a really good thing to use. So if you were, say, already retired, you might choose one of the target date funds from somebody like LifePath from BlackRock. Vanguard has them as well. And you can look at their retirement funds and think, okay, what did they put together for people who are retired? And you can compare that against your portfolio or what you expect to build. There's a lot of information out there if you kind of understand how to look at it. And then in our stage 3, we had all of our more growth securities, things that are really just trying to fight that long-term inflation hedge and grow our value over time, like S&P, internationals, and a little bit of a managed fund. So again, the things to remember is that each portfolio is going to take on a different form based on what it's trying to do. That's just had a request from a client that they don't need all of their distributions from their IRA that they're required to take. And so they want to set up an intermediary account. And this account is going to be basically for cash management. I'm going to put together a portfolio that is not very high in cost, doesn't have a lot of stocks in it, maybe a little bit of preferred stocks. But the idea is to just be invested in things that don't have a lot of volatility, that spit off a decent amount of yield, that basically is just kind of a upgraded version of a savings account or a money market account or something like that. So just trying to earn a little bit of that extra yield without getting into growth. It's not a moderate portfolio, but it's also not just one treasury fund holding. So that is a totally different portfolio. It will still have the different stages. It will still have ultra short treasury bills in stage one. It will still have managed bond funds or intermediate term or aggregate bond funds in the middle, and it will still probably have some preferred stocks or minimal volatility stocks all the way in stage three. The stage three is going to take up a very small portion because the purpose of this account is to serve as a place to accumulate cash and earn money on cash and not have tons of volatility. So that's really informing the difference versus the IRA that the money is coming from. The purpose for that is to maintain and continue to grow the nest egg over time at a reasonable rate while still being able to provide money for them to take from. So that's kind of two different portfolios that are informed by their objectives and what their purpose is. So I really like to use each account and name it and say what it is, what's the purpose, so that everything that I do aligns with it really clearly. Yes.
Has these two separate.
Yes.
I see, so it's not all in one.
Right.
vehicle. Be all things.
Exactly. Exactly. That's kind of how I like to do it. I'll tell you that, and then I'll tell you the perspective of another client that I have. So for them, they came over and they had this big IRA, rollover IRA from one of their 401ks. Like the husband had built up a nice nest egg, and so that was the account that they rolled in, and then they wanted to manage. And then he turned 73, and now he has to start taking his RMDs every year. He gets no choice. He has to take out like 3.5% every single year, and that'll continue to go up. Thing is, though, they had already managed their cash flow perfectly. They had pension, Social Security, and they were living exactly on that. They had enough savings. There wasn't really any need for this extra cash that they were forced to take. And so I proposed the idea, well, how about this? Instead of making you go do the work of you figuring out how to put your cash to the side and make sure it earns the most and all of that, let me take care of that for you with a joint account that we put together where the RMDs come right out of the IRA and then they go into this joint account and then we invest them whenever they need them, they can take them. And so it separates those two sort of objectives of here's your extra cash, you hold on to your emergency fund, but otherwise, if you have extra cash you're sitting on, let's just put it in here and we can earn a little bit of extra interest instead of just making them do all the work of figuring out which CDs they want to buy. Do they need to switch banks to get better rates and all that kind of extra stuff? So that is one possible benefit of having an additional brokerage account on top of retirement accounts and other things, because you have access to a lot of different vehicles like money market funds, treasury funds, and income funds, and all of the sorts. It's a really good place to be able to get those higher yields without having to bounce from bank to bank to bank to bank to bank to chase the higher APRs. So something to think about. Yes.
Expand a little bit of how a brokerage account works and the do's and don'ts and.
Sure. So when I say brokerage account, it's kind of confusing because in the term brokerage account really applies to most investment accounts that aren't like 401ks or like a mutual fund company account. Really, a brokerage account is simply something that gives you access to where a broker dealer can then provide you with products. That's the real like underneath term. But in the industry, we tend to not call IRAs or anything that has a tax advantage a brokerage account. We consider a standard, like in our firm, when we say standard brokerage account, we usually mean something like an individual or joint account that's not managed by the advisor and it's commissions based, even though we just waive the commissions. So when I say brokerage account, I usually mean a taxable account, like an individual account or a joint account. One thing, we'll talk about this a bit later, but just the normal thing, the do's and don'ts that I would say, make sure that if you have an individual account, you want to either have it be a trust account that's registered to your trust, or make sure it has a transfer on death or a payable on death provision attached to it, which is essentially just like taking an individual account and putting a beneficiary on. So just like with everything else, always make sure you've got a beneficiary on that account. And then if we're talking about joint accounts, if you're in a state like California that has community property, I would almost always opt for the community property registration versus joint tenants with rights of survivorship for married couples, because the entire basis gets stepped up at one owner's passing, rather than the other joint account, only the person who passed, their share is the only bit that gets stepped. We'll explain that in much further detail in a later class, but yes.
But if you buy funds and stocks from different places, kind of like a universal account.
Yeah, that's basically what we were describing earlier. Is a brokerage account essentially just connects you to a broker dealer, and then everything that they have access to, you now have access to by buying it. That would be something like if I have an individual brokerage account at Schwab, so anything that Schwab provides as a product, I can purchase in my brokerage account, and then yes, even their competitors, because the people that they're competing with as a broker dealer, if my money's not there, they're winning. And then, of course, they want me to use their funds. So if you use something like a robo-advisor, they'll stick you in all Schwab, but they'll let you buy everything. You might, depending on your brokerage account, you might pay higher fees or commissions to buy other companies' funds, particularly mutual funds. We have this at our practice. So for us, because our custodian, which is the place that holds the assets, because they are an arm of Fidelity, all Fidelity products cost nothing to trade. So when I have smaller accounts, I use those because every trade is free. It doesn't cost anything. Versus the other products, the more diversified products, those will cost $7 each trade. But then on the mutual funds, they can impose an additional trade fee. So Vanguard tax on another $10. So it becomes $17 to buy a Vanguard mutual fund. So it kind of depends where you're at. For the most part, on the retail side, for all of you, if you're just opening an account at a broker dealer like Schwab or Fidelity or Robinhood or whatever the case may be, they try and get those costs as close to zero for you as possible. That's kind of their way to get you in the door for their other services. So let's see. A portfolio can be as simple or complex as you'd like it to be. We can have it be 1 fund, 3 funds, 5 funds, or 15. But regardless of whatever the number of funds is, no matter how many products you have in there, make sure that they're diversified. What I want is that if I plug your portfolio into Morningstar, into Y charts, whatever the case may be, I want to see that you're diversified among different sectors of the economy, you're diversified among different asset types, you're diversified among risks, that those unsystematic risks that we talked about before, individual company risk or the default risk or any of those things, that we've really managed that away. We want to make sure that even if it's just one fund, like VBIAX, the Vanguard Balanced Index Fund, we want to make sure that that fund is diversified. Does it hold a ton of bonds? Does it hold a ton of different stocks? Is it actually well diversified? That's the key thing. I don't care how many funds you have. I just want to make sure that you're diversified. And when you're concentrated, you know it and you're making that decision actively. That's the number one. So make sure that you bias your holdings towards low-cost investments, because time and time again, fees are going to be your number one detriment to your performance. And it's always when you're paying fees, I always want to make sure it's clear. It's not necessarily a bad thing to pay fees. Just know what the value is that you're getting and accept that as worth it for the fee that you're paying. Because, I mean, you can make the argument that, well, why would you work with an advisor that charges you a fee on your assets? It's like, that's fine. If you're paying them to perform better than whatever is out there, then yeah, you probably shouldn't be paying that fee. Or are you paying a fee for them to manage it for you so that you have an understanding that everything is taken care of? Is that worth it? Then it is worth doing that for you if you assign that value to it. Do they do planning for you? It's all about how you feel about it. It's not really so much about the number, unless it's ridiculous and like 2.5 or 3% of your money every year. It's really just about, do you find enough value out of it to accept the proposition? So today we're going to start diving into some more fun, complex stuff. This is where I start getting excited and I start really looking like a nerd if I haven't already. We're going to start talking about modern portfolio theory. This will be stuff that we use to measure risk, things that we use to measure performance as it relates to that risk, and basically how we can use these things to look at funds and determine whether we think they're good or bad. Now, it's important to understand that though all of these metrics are very useful, there's not a single one of them that can look into the future. Not a single measurement. I don't care if you have a mutual fund that has had the best alpha for 15 years straight compared to whatever index you're doing. It can't calculate how well it's going to do in the future. You cannot forward see anything. All of this is going to be based on historical data, which is great and it's useful and it's what I use every day, but it's never going to be a guarantee. So if you find something, if you pull up a fund, you go, wow, that has like the highest alpha ever on a 1-year trailing period. Okay, great. They did really good for 1 year. They could have bought one good stock, and that completely just shows, like, makes you think that it's the best thing in the world. But just understand, all of this is historical. All of this is based on different time frames. So make sure you know the time frame you're looking at. Make sure you know what events are occurring, and all of that context, really important to know. So there's a couple different investment analysis tools, portfolio analysis tools that you could use. I'm going to tell you about my favorites first, and then we'll kind of go through the rest. So me personally, I use Y charts. It's probably going to be the most expensive one on this list. We pay a very pretty penny for it, but I like it because I can customize a lot of things. I can move stuff around. I can make these beautiful dashboards where I get to see all of this economic data and different indices moving against each other. I can see a lot of things, and it also helps me create charts and content for presentations for classes or for clients or for emails. It's a very useful all-in-one tool, but it's very expensive. They do have a free trial though, if you want to try it out. You can, I think it's a 7-day free trial, 7 or 14. I don't remember which, but there is a little one. Just make sure you see how much it costs and don't let it auto renew. The next one that is my second favorite is Morningstar Investor. I think that is the best bang for your buck that you're going to get, just because of the wealth of information that it gives, the familiarity that most people have with Morningstar when it comes to professionals and retail investors alike. It's still a little bit expensive. We pay like $300-ish a year for it, which is really not that bad if you're doing a lot of work with it. But you can also get it for a little bit more inexpensive if you stay looking in your emails. There's a library card you can get for $40 a year that gives you free access to Morningstar Investor. So if you like to save a little bit of money, there you go. Morningstar Investor is great. It gives you all of basically the same information that Y Charts does, and they also give you what are their medalist ratings, which is essentially their analysis, their analysts telling you how good they think the fund is and how much they expect it to outperform over a given time period. Not with a percentage number, but just kind of their confidence. Next, Google and Yahoo Finance are great free tools. A lot of people will even use these to run like AI. They'll plug their AI into the API of these programs, and they'll do a lot of analysis that way. So it's a really good free place to find things. I use Yahoo Finance all the time. Like, I'll even use it if sometimes I'll have Y charts open in a second monitor, but I just really want to quickly go in there and look up a stock and see what's going on. So even now, I still use Yahoo Finance sometimes. Google Finance is just pretty much Google's mimic of that. They both are really great. They're both covered in ads, obviously, so put on an ad blocker, but they are good places if you don't want to spend any money. And you can create an account and put your portfolio in there and do a little bit of analysis. Interactive Brokers, they also have one called Portfolio Analyst. I don't really have much experience with this, but it is kind of on the same level as these previous tools. PortfolioVisualizer.com is cool. The thing that I like about it is it has this back test tool to where you can add your holdings and then you can run it over like a previous amount of time, and you can see from whenever the newest fund was created, you can see how it's performed, what the drawdown was in different periods. It's a really good way to, if you're looking to create some changes, to be able to look back on what this portfolio would have experienced in recent timeframes, or even stretching back into 2008 if your holdings have existed that long. So that one's really cool. I like doing that for testing stuff. I like throwing that in and seeing like, okay, what's the difference if I put this in here or slightly decrease that one and increase that one? That one's a fun tool for me to work with as well. And then you might also have tools provided by your broker dealer or investment advisor. They might already provide you something for free along with having your account that you can use to look at your thing. So there's plenty of options out there, but we're going to focus on Morningstar because it's the easiest for us to give you access to and is the most comprehensive. So we're going to be based on that. I look through the lens of Y charts, but the information is the same. The only thing really that's any different is the analyst ratings. That's pretty much it. Otherwise, informationally, they're the same thing. So Morningstar provides a comprehensive, in-depth look at investment products and portfolios to help us choose assets for our portfolios. There's plenty of metrics that we can use to evaluate both individual assets and investment portfolios. So just like these metrics can be applied to an investment like the S&P 500 index fund. They can be applied to a stock itself. They can be applied to your portfolio as a whole. You can really kind of use this as a tool to look at everything together. And that's why we like using it, because it allows me to put in all of my holdings, all of the stuff, and get a really comprehensive picture of where I'm standing, what my risk is, and what sort of volatility I can reasonably expect. All of the stuff that we're going to talk about today, well, most of it, is based on something called modern portfolio theory. I've said the phrase a couple times, but I haven't really bothered to explain it very much until now. Modern portfolio theory is a strategy that focuses on investing in different asset classes to reduce investment risk while achieving the best return possible. So the idea is, bless you, that you're trying to reduce your risk as much as you can while still getting good returns. So we don't want to reduce risk so much that our returns fall away, but we also don't want to increase returns so that the risk is just absolutely ridiculous. We want to be efficient with our returns. Each asset class has forecasted annual returns and levels of risk. You can kind of think of those forecasted annuals as what is the historical average? What can we reasonably expect into the future? There's a lot of statistical analysis that goes into that. Investors can invest in multiple asset classes to leverage the maximum level of risk they're willing to take for a chance at more returns. Modern portfolio theory works by optimizing the level of risk an investor is willing to take to achieve returns. So again, it's taking that level of risk that you're willing to take and making sure you take it in the right direction, because you can take similar levels of risk and not be compensated for it. You remember those bond funds we were looking at, the long-term bond funds that are still down 30%, 40%, or the bond aggregates barely breaking even now? If you had invested while rates were really low and you bought those bonds, your risk was really high because there was nowhere for interest rates to go other than up. And you weren't really going to get compensated. The value of the bonds wasn't going to go any higher. So you were essentially buying into a failing investment for the short term. And then that would have crashed. And that's a lot of risk, a lot of volatility, a 30, 40% move. But if you had invested in a different asset class, either a shorter bond fund or even a stock fund, you would have actually had an opportunity to be compensated for that risk that you took. So those risk levels based on that environment could have been similar, but you would have had to be diversified to actually be compensated for that risk that you were taking with the bonds. Similar for how you can take a certain level of risk with one or two stocks, and you may not be compensated for either of those stocks. They may both fail. But if you invest in 100 stocks, it's much more likely that you're going to get compensated for the risk of buying each of those stocks, because all of them have a chance to grow and you're not putting all your eggs in one or two baskets, right? Okay, so this definition just comes from Morningstar, from one of their writers. But the guy who created modern portfolio theory is Harry Markowitz. He actually received a Nobel Peace Prize for in economic sciences for developing the modern portfolio theory. So his work popularized concepts like diversification and overall portfolio risk and return, shifting the focus away from the performance of individual stocks. So this is kind of the thing that got us to start looking at portfolios as the whole thing together, as the vehicle, rather than like, how can I buy and invest in one individual security here and there and have that run my performance. So he helped us bring these sort of probability and statistics together to help us create diversified portfolios and protect ourselves against risk. I'm not going to get too much into what all of this means, but you can basically think that there is a certain level of expected return that we should get for taking any level of risk. So on the x-axis here, you see expected risk. So you could think of that as like standard deviation, or just how much variability is there going to be. Thinking of like treasury bills all the way down here, and then you got your Tesla stock all the way out here, right? And the idea is, you know, after the risk-free rate, which is basically a 3-month treasury bill that varies, but whatever the rate that pays, the more risk we're taking, we should get more return. That's the point. That's the whole thing about investing. That's why we choose stocks for longer time periods, is because when we take that longer risk or more risk, it's expected that we earn more return. Now, like I said, depending on the risks you take, there can be inferior portfolios, right? That you take extra risk, but you're not getting the return that you should be according to the capital market line. And there's all of these different portfolios, and according to modern portfolio theory, there's some mix that gives you the right amount of risk or the right amount of return based on the risk that you're trying to take, and it is what's called optimal. You don't have to worry about this chart. We're not going to be plotting our portfolios on it or anything like this, but it's kind of just some of the under the hood stuff that's happening when we take these statistics and apply them. So modern portfolio isn't perfect because it makes two assumptions. One, it assumes that the market reacts immediately to new information and it's priced in instantaneously. I would say that's a pretty good argument for most large cap, super hyper popular stocks like Nvidia and Microsoft and whatnot. Even stuff that hasn't happened that people think is going to happen gets priced in, right? Like all of it's like instantly getting into that. As you start moving to lower and lower volume, stuff that's not traded as much, I think there's a chance that not everything is priced in instantaneously. But if we use that as sort of our assumption, it helps us, you know, participate in a way that where we try not to do too much market timing, which is really hard. And then the second assumption is that all investors are all risk averse and completely irrational. I think investors may be generally risk averse, but I know that investors are not completely rational. And that's kind of like, that's part of my point when I talk about risk tolerance. It's like, you have to disconnect yourself from the idea of the return in the investment. Like, what's going to make you change your mind? What's going to make you fall off course? It really is like a human game. Like the numbers, that's the easy part. It's you get diversified, you invest to a certain level of risk. It's the human part that's the hard part. Yes.
Wouldn't insider information also fall under that?
Yeah, so that's basically one of the things that, you know, it is going to miss. It kind of is investing on the assumption. Well, really what it is, it's not assuming that insider information doesn't exist. It's just assuming that you're never going to have it. And that's kind of like, you know, because those fluctuations are going to happen. You know, that's going to be part of the market, but things will generally equalize.
You have information that others don't.
Right. And then that's going to, right. And it does for those people who have insider information. For the rest of us, though, we basically have to, like, because we're not going to have access to it, we have to invest based on this assumption.
Saying the inside information does exist, we just don't acknowledge that it does.
Yeah. Well, we acknowledge that it exists, and there's just nothing that we can do anything about it to like profit from it. Like there's nothing that we can do. One, right, exactly. But then of course we're not in the government, so then it's actually going to be illegal for us. So, you know, it's only legal if you're the ones who say whether it's legal or not. So it's a whole other thing. Yeah, well, except for us, it matters to us. But so historical risk statistics can also break down when you get to smaller time frames. That's one thing that's also really important, is that, you know, historical risk, just like we talked about average returns for the Dow Jones is like 8%. It's like, yeah, okay, 8% year over year. That sounds pretty good. Years are not going to be 8%. Pretty much 9 out of 10 times, they're not going to be 8%. It's going to be 30% or 10% or negative 20% or absolutely nothing. So we have to understand that, yes, while these statistics do apply over long time periods, they apply over long time periods. They don't just, you can't expect that something's going to stay within its 10-year standard deviation within a 3-month period. It's just not realistic. So make sure you are actually holding on to that context of timeframes. So our goal with modern portfolio theory is to optimize security selection within the allocations we already determined with lateral and vertical integration. So we chose lateral and vertical integration to choose what kind of stuff that we're going to have in here. And now we're going to be looking at individual securities, applying modern portfolio theory to know that the pieces that we're putting in are the best pieces we can pick. Always understand that these measurements come from specific time periods. It's like the 4th time I've said this, but they'll often be associated with a certain look back period. So if you see something like you see a statistic like beta or alpha or standard deviation, you're going to see little parentheses next to it. 1 year, 3 year, 10 year, or maybe since inception, which is also one that I use sometimes. And so it's just, you have to understand that it's based on that period of look back, because it has to use some set of data to come up with this conclusion. So we have to put like, it's a 1 year, a 3 year, a 5 year, a 10 year, whatever the case may be. So the more data you have, the better that is, because the more reliable that's probably going to be over the long term. But you can also kind of make some assumptions based on what asset class it's similar to. So if we're looking at a small cap value stock, for example, if it's not actively managed, something like a factor fund, you might be able to look at small cap value in general and look at its risk profile with an index and kind of be a little bit more comparable. But let's talk about some modern portfolio statistics, modern portfolio theory statistics that you might see on a Morningstar report. Don't worry about the math too much. I'm not going to make you do any math. I promise. I promise. We do all the math for you. That's what we do. So beta is a measure of volatility or systematic risk, market risk, just the risk that there is investing in the market of a security or a portfolio compared to a benchmark. Now, I get so frustrated because sometimes the definition will say a benchmark, but almost every time they will say the market or the S&P 500. And then you go on something like Morningstar and you print out a report and you go, why is the beta of this T-bill fund 0.9? It's not a stock fund because they're comparing it to the bond index. So it's important to understand that beta will always be a relative measurement compared to some index that happens to most of the time be the stock market or the S&P 500 index. So essentially, what we're looking at is a measurement that just is a standard number with 1 decimal point. A security with a beta over 1.0 has more risk than the benchmark. 1.0 is the risk of the benchmark, and a security with a beta under 1.0 has less risk than the benchmark. So you can just convert this to like a percentage if you want. So if you see something with a beta of 0.6, you could say that's got roughly 60% of the volatility of whatever I'm looking at. So if I'm looking at a dividend ETF and I'm comparing it to the S&P 500, it might have a beta of 0.7 or 0.8 because they tend to fluctuate less in comparison to the S&P 500. There's a whole bunch of fun ways that that's calculated. If anybody cares, you can go ahead and read that, but we don't need to get into the math of it. In the next 3 slides, what we're going to do is we're going to use this measurement of beta, and we're going to look at a comparison between 2 products. One's going to be the S&P 500, So we're going to use the S&P 500 index, SPX, and we're going to choose an ETF from Vanguard to display how beta can be seen in real data. So these will be charts that show historical or historical returns, but comparing the S&P 500 index and a fund of my choosing. The S&P 500 will be a purple line, and the comparing ETF will be an orange line. Together, what we're going to do is we're going to look at the charts, and we're going to see if we can figure out what has a higher, lower, or similar beta to the investment or to the index that we're looking at. And we're going to assume a 5-year look back. Now, this isn't going to be up to date. This is just going to be when I put these charts together most recently. So if there's any missing data, forgive me, but it's just on the 5-year look back period that we have displayed. So first, what we have here is we have the S&P 500 in purple, and we have Vanguard's total stock market index fund in orange. Now, I would like to know, do we think that the beta is higher? Anybody think it's higher? Okay. Does anybody think that beta is lower in comparison to the S&P? Okay, we got one, we got two. Anybody think it's relatively the same? Yeah, people know relatively the same. So it's pretty much the same. 1.02 is basically exactly the same. Now, you might get a little confused because you might see a period like this where the line is below, and you might think, oh, well, doesn't that mean that its volatility is lower? Well, not necessarily. There's also periods where the line is higher. So really what we're looking at is it's not how far the line goes up, it's how far the line goes away from center. It's like up and down. So if you see that it goes up further than the index sometimes and down further than the index sometimes, that means that its risk is slightly higher, which means their beta is slightly higher. So even though it's very, very, very similar, there's a teeny tiny little bit of extra risk. And for this particular example, that's because the ETF that we're looking at, VTI, includes mid-size and small-size companies as well as the large ones in the S&P. Any questions on that? Yes.
Where's the one that we're looking at, the one that we're comparing against?
So the S&P 500 is in purple, and the Vanguard total stock market is in orange. Yes.
But is it about, are we looking at the numbers on the left?
So we don't care so much about the numbers. We're caring mostly about what we see visually. So this is a representation of basically what are the returns. Like if you had held this, it's going up and it's going down. And this is just kind of its activity over the last 5 years. So we can see that the activity is a little bit more in the orange line because it rises a bit higher over here and it drops a little bit lower over here. And it's basically in tandem here. But the performance is relatively pretty much the same because they both hold a very similar allocation of stocks. The total stock market just has some extras. Yes.
How similar are they? Because the total market might have 1,800 stocks.
Mhm.
The S&P has 500, but then most of the total market is very similar.
Right. So another reason that the performance here is going to look so similar is because of, and this is something we've talked about a couple times before, but most index funds, because they're following an index, most indexes are calculated with what's called market cap weighting. So market capitalization, you take the share price of the stock, you take the outstanding number of shares and you multiply them together and you get this completely arbitrary valuation number of a company. And then the idea is out of the pool of all of the companies, like what percentage does that amount represent? So NVIDIA's market cap represents approximately 7% or 8% of the S&P 500 of total market funds. So you'll see that because it is just such a giant company, you'll see it at the top of those funds. So anything that is an index fund, total stock market, S&P 500, NASDAQ, you're going to see very similar holdings in those top positions for all of these index funds because they're all calculated the same way. If you saw something like equally weighted, that would then look at the list, and instead of using market cap weighting, they would buy the same amount of everything. So that might be a different story, but then the returns are different. That gets all fun and complicated.
One has a little bit of a tail, right?
Mhm.
Some small caps. But the main part of the comment, the two different ones, The S&P and the total market are mostly the same, but the S&P has extra little tiny stocks, like a tail of a comet. They don't have a lot of impact, but they can make the charts look slightly different.
So obviously that was the total stock market ETF with a beta of 1.2. And now we're going to look at one more. So again, remember that the purple line is the S&P 500 and the orange line is our ETF that we're looking at. Now I want to ask, how many people think the beta is higher? So I see, okay, we got a few. How many people think the beta is relatively the same? No. How many people think the beta is lower? Well, we've got a smart group. The beta of this investment is 1.178 as compared to the S&P 500. So that's 17, 18%, almost 20% more volatility. And that's due to the fact that the growth factor tends to have much more volatility. They're not usually the stable companies. They're usually companies that are, they're going for market share. They're reinvesting all of their capital, all that kind of stuff. And so I drew these boxes to kind of draw you in to what would have clued you to this this conclusion. You can see here that as the S&P 500 index drops, this ETF drops decently further than it. There's a nice little spread between how far down the S&P went and how far down this ETF went. Similarly, as we began to recover, you can see that it starts to perform much more strongly. But again, as it goes up, it goes down more. So it's just kind of like if you took the S&P 500 and you just kind of stretched it out, it's going to move in a very similar way. But because of the types of investments that are in there, it's going to be kind of like, you can kind of think of it as like, this is like half of the stocks that are in the S&P 500 that are way more volatile than the other half. So the other half are going to be much more stable. They would be moving less, but you can see here in these moments, when you see those big wide swings, that's showing that this is more volatile relative to the S&P 500. So next we've got one more. Remember, purple is our S&P 500 and yellow or orange is our ETF. Now, we're going to ask you again, how many people think the beta is higher for this investment? You can just use process of elimination at this point. How many of you think the beta is relatively the same? No? And how many people think it's lower? Well, there you go. Because the beta of this investment is 0.8136. Remember, I was saying if we looked at value stocks or dividend stocks, we would see approximately 0.7 or 0.8. That's exactly what we're seeing here, because what we're looking at is Vanguard's value index fund. So they are chopping up the total market, and we're looking at just the value stocks, what they determine as value stocks. And you can see here that as the S&P dropped, these stocks were more stable. On average, in this 5-year period, these stocks did not drop quite as much. However, they didn't recover as much either. So when we give up that volatility, that downside risk, for the most part, we're also giving up that upside potential. So it's always a trade-off game. It's like, yes, if we can get more return, but we have to take on some extra risk for it. Yes, we can get less risk, but we have to give up some return for it. So beta can give us a general idea of how risky any security or collection of securities can be. Because like we saw, this could be applied to this index fund, but we could also apply it to an individual stock if we so chose. We can also apply it to our entire portfolio. So beta can be used for evaluating both individual funds, stocks, as well as the overall portfolio. So beta is a really nice way to kind of think about how much risk do I have compared to those stock market indices that I see flying up and down on Bloomberg all the time. Like if I see the S&P going, if you know that your beta is 0.6 and you see the S&P drop by 5%, you might think, okay, well, I'm probably only down around 3%, and it gives you some peace of mind, some easy sort of reference point that you can call back to for the volatility of your portfolio. Remember though, beta is relative and it requires understanding the benchmark you're comparing it to for an accurate risk assessment. If I compared a growth stock fund to the bond aggregate, it wouldn't be fair, and the beta would be 3 or 4 or 5 or 6 times, and it just wouldn't really make any sense. So in a lot of cases, it's going to be the S&P 500. But maybe for a bond fund, it would be the aggregate index of bonds, or for treasury bills, it would be the treasuries. So it just kind of depends what you're comparing to. So always remember that you need a benchmark, and it's always going to be relative. Now, before we talk about alpha, let's take our little break. We'll give you a chance to get ready for some more fun numbers. And then we'll come back in a little bit and we'll get right back to it. All right, before we get back into all of the fun investment and analytics and all this stuff, I actually got this email as we started. So the Renaissance Society is having a dinner and dance celebration. So if anybody wants to get together and put on some Halloween costumes, they're having it at this Italian restaurant that I am not even going to try to pronounce. Well, let somebody else work on that. They've got a buffet. I'm considering it, honestly. That might be a good time. It's from 4 to 7 p.m. I got socializing. Oh, dancing with Frank Martinez spinning tunes. All right, I think I might be there. So, yeah, exactly. Okay. All right, let's get back to the stuff. Okay. All right, yeah. I sure hope so. Okay, so now, next thing we're going to talk about. So we talked about beta, which is our relative risk measurement. And the reason that we talked about beta first is because now that gives me an opportunity to talk about alpha. You may have heard the word alpha before, and essentially what it boils down to is alpha is the extra risk that, or the extra return that you have made for taking on a certain level of risk. So you remember how I was saying that you could take similar levels of risk, but one could perform not so great and one could perform a little bit better, right? Similar volatility, one performs better. You might even be in a case, and this is particularly happens with speculating and individual stocks, where you might have two stocks and one performs just as much as you need it to. It matches the S&P, great. But you might have another stock that goes flying and performs way better, and it's still the same level of volatility, but all of the volatility is up. In that scenario, you're going to have what's called alpha, which is the excess level of return that you have for the level of risk that you've taken. So let's go through these definitions a little bit. It refers to excess returns on an investment above the benchmark return when adjusted for risk. So it uses beta as a gauge of risk and how much return we should, in theory, get from our investment. The returns above and beyond the expected amount for our given risk are what are expressed as alpha. So usually when you hear the word alpha, it's viewed as the value a portfolio manager adds to or subtracts from a fund's return, because it can be negative. If you have negative alpha, you're essentially underperforming your risk level or the benchmark or whatever the case may be. Now, the reason that we use beta in this calculation is because you might have an investment with a higher level of risk, and your expected amount of return needs to be proportionally higher to that risk that you're taking. Okay, so I am going to actually walk you through the math on this one because it's much easier, and it makes it a little bit easier to understand. Alpha is what your return was, and then you subtract this number, which is basically you take how much the market returned, so usually the S&P 500, you subtract out the risk-free rate, which is what you can get just for buying a T-bill. A 3-month T-bill, you might get 4% per year. But usually we say 3. So if the market returns 10%, but there's a risk-free rate of 3, we're going to subtract that out, and you're going to have what's called the market risk premium, which is 7%, right? But now you need to take that 7%, which is the market part of the market return without the risk-free rate, multiply it by the beta, which is the amount of relative risk that you're taking on. So then that increases what that return should be. Then you add back that risk-free rate you took out before, because you don't want to apply the risk multiplier to the risk-free rate. And then that should match or be less than your return. So if your return is less than that number, if you have come out with a negative number out of this calculation, then you would have earned less than you theoretically should have, given how much more risk you took than the thing you're comparing to. So alpha accounts for the risk taken, as well as the return that could be made by taking on zero risk, by buying the risk-free rate, giving a truer measure of excess returns than if you just took, I got 12, it gave me 10. That might sound great. It's like, oh, the stock market returned 10%, but I returned 12. But if your investment has a beta of 1.5, well, your return should have been closer to 15 or 16%. You actually performed on a risk-adjusted basis less well than the S&P 500. So it kind of like gives you this way to measure when you account for that risk. So the riskier an asset is, the greater returns it will need to generate to produce alpha. Index funds don't have alpha. They never will. They will have a tiny bit of negative alpha because of the fee. Because all that they're doing is tracking and performing the index. They're performing exactly the same as the index. So if you look at like a ticker like VOO or SPY, and you go, why does this have zero alpha or negative 0.03 alpha when compared to the S&P? Because it's doing exactly the same thing and paying a tiny little fee for it. So if you see no alpha on an index fund, that's not a problem. That's exactly what it should be. Now, short time frames can skew alpha a lot, especially during unusual economic cycles or due to the performance of a single stock inside of a fund. What I like to call back to, does anybody remember the name Kathy Woods from ARK Invest? She rose to popularity very quickly with her fund doing really, really well over a short period of time because she held way too much Tesla. And Tesla happened to be doing amazing at the same time. And so her whole thing was like, I'm creating this innovative ETF and we're getting in all the innovative companies that are all going to do the best. And obviously I'm doing so great at this. Meanwhile, she's invested like 20, 30, 40% in Tesla shares, right? And so we'll see that represented here. Purple's going to be the S&P 500. And orange is going to be the ARK Innovation ETF, which was Kathy Wood's sort of like predominant flagship product at the time. Now you can see that, okay, you know, we're doing all right. Yeah, it dropped a little bit more, but then woo, it's doing better. It's like, yeah, okay, our beta's pretty high. That's fine, but it's, you know, it's performing as we think it should. And then, oh my, holy crap. And it just goes flying. And it's up by like 700% at the time where the S&P was maybe up like 100%. And we go, wow. Now, if we shop down to right here and we measured this and we use that for our time frame for measuring alpha, the alpha would be off the charts and it would look like the best possible fund that you could get ever. But then if you include all of the data, you have to remember that all of this volatility is the thing that we're concerned about. We have upside and we have downside. So the beta of that's going to be like twice the S&P. We don't quite have twice the returns. So that's one of those periods where it got skewed because of individual stock performance. Now, this can be a fine thing if they can be consistent, but this fund did not have quite the same success. Yes.
Why couldn't you just, when you have something you're invested in, peak like that, say, okay, I'm out. Like, I don't care if it goes any higher. I've already just made a good amount of money.
Yeah, and that's absolutely a totally fine thing to do. The one thing is just like, it's really easy to say that when you look at this chart, right? Like even like I think like, oh, well, I could have just bought it and then I could just sold it up here. If you don't have any of this, you don't know if that's here, 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 or here. Because you can't see ahead into the future. Now, you're absolutely right that if it spikes like that, you sell. But how do you know when it's going to stop? Like you might think, okay, well, it's not surely not done here, but then maybe this is the moment it turned around and it decided to go all the way flat. Yeah, absolutely.
Yeah.
Absolutely. And so that's kind of why I like to, why we operate on basically what's called drift. So if I have a certain position in my portfolio, let's say it's a tech fund, something like this, and I say I want to have it to be 5% of my portfolio. If it has an absolutely ridiculous run and it doubles in price, it might still be a good investment for me. But now if it's 10% of my portfolio, that risk is too high for me. So I'm just going to chop it right back down to what it's supposed to be, reallocate that to the rest, and keep it at the 5%. So that's kind of like, that's how I kind of do that, but with a system. So instead of like basing it on this, I just go, well, if it's way out of my tilt, I'm going to bring that right back to where it's supposed to be. That's why it's a good idea to sort of have like an investment plan. Like, what's my portfolio going to look like? How big do I want these positions to be? That's kind of how I'm trading. Yes.
Would, gold at 4,300 be similar to that?
Yeah, it would be kind of a similar thing because again, it's a lot of this sort of emotional hype and flocking to safety, as people like to say, or fighting against inflation. Gold is just something that people always run to when they see weakness in the dollar. So again, you can have a bit of gold in your portfolio, but just understand that when it starts really running out of drift, if you have a 2.5% position and now it's 6 or 7 or 8, now all of that value of your portfolio is vulnerable to it dropping all the way back to the 2% that it originally was at before. Yes.
The question is, well, when is it enough? And I'm thinking of my stepbrothers who grew up in Hawaii and they rode the waves and they were
Yeah.
super surfers. And the thing is that they could hit a great wave and, you know, you and I might say, hey, that was big enough. But there was a sense of, but what about the next one? Maybe it'll be
Yeah.
there. And then that's why they stay out for so long, because it could get higher or it could go lower. So it's trying to figure out what am I okay with it being enough? To your point, I think that's, I think there's a lot of people who do the surfing model instead of always chasing the next higher piece.
Absolutely. Absolutely. And I think that kind of like, to me, that justifies even more the idea of vertical integration, where you set your baseline with your index funds. Maybe you tilt a little bit to value because you like blue chip stocks. Then on your little allocation, you can do as much chasing as you want. But it just, as long as you have that base in there that's going to take you where you need to go, regardless, and it's gonna do the thing that you need it to do. If you want to have some fun on top of that, go for it. In fact, I actually think it is kind of a little bit better to allow yourself a little bit of play freedom, to give it there so you can allow yourself emotionally to experience that, or to like even either prove yourself right or wrong. Like if you end up being the next best trader, you can add a little bit of extra returns to your portfolio, good for you. Or maybe you could see, wow, I wasn't cut out for that. And it's a really good thing that I had 70% of my portfolio allocated in a nice broad index fund. So, you have a question back there?
In the strategy of going back to where you're, going back to the 15%.
Sure. Yeah. So it's basically just kind of making sure that everything behaves and stays in line. And the idea is mostly that if I have a position, the reason why I have it at a certain size is because that's how much I want my portfolio to be vulnerable to its specific risk. So like if I have an energy fund, for example, that's a very targeted investment. It's a very volatile investment. If that's 20, 30, 40% of my portfolio, I better be pretty sure that the rest of the portfolio is enough to fund and take care of my needs regardless of the performance of the energy. So if it's not, then I should probably scale it back to the point where if this fails, it's not going to be that big of a deal. So that's kind of like why we choose those allocations and we talk about drift and maintaining that.
Research, it's something 3 months, every 6 months, I look at it. Like we've had utilities were way up there and you rebalance some of it, not all of it, to something else that happened to be down quite a bit. So you don't want to let the portfolio get out of balance. Then again, you might, and that's why you should get a call from your advisor if somebody is doing it. So the question was balancing a portfolio when it gets out of whack in some position. A few years ago, he got me out of energy. I bought into energy right at the bottom of the pandemic because prices were low. But then everything went so high, then he looked at it and said, look, this is getting to be too big of the portfolio. We need to move this into total stock market. And that did pretty well, a lot better than my energy is doing today. But he also caught utilities only because it spiked way up there. It was because of the data centers and all this stuff. So he had everybody sell a little bit of the utilities just to be safe. It's like when you watch a child crawl up a tree.
Well, there's a point where they're getting too high, and you've got to be willing to cut it off and rebalance it, and it might keep going. But we don't want to take the risk that if it collapses, you've got a serious problem. And gold is one thing. People are asking, should I buy gold? Not now. You should be selling it now, possibly. I bought gold at $975, $900. That's a pretty good price. But that was 1979. And right after I bought it, for the next 15 years, it was $200, $300. So very good questions. And that's why looking back and rebalancing is important. You've got to give up some future gains to avoid future losses that could be catastrophic.
Yeah. So actually, just as you were talking about that, I had a thought that reminded me. So you can kind of think about using portfolio drift and saying, this is how much my position is. This is how much I'm allowing it to grow or decline before I reallocate and get it back to the position. It's kind of like dollar cost averaging without adding new money, right? Because the idea is I have a position that I want it to be 5%. If the position increases to 10%, but another position decreases from 5 to 2.5, let's say energy is up, like in our example, energy was up a bunch. Let's say something like consumer discretionary was down, consumer staples are down. We have other investments that have decreased in value. When it increases out of our drift, and now we have to sell piece of it to bring it back in line, we now have this extra capital. And we look over to the other positions that have declined in value that are now relatively cheaper, and we're able to buy back more shares at lower values, applying that similar dollar cost averaging concept so that when a position declines a bunch, we sell from the stuff that's up and we buy into it, sort of reallocating dynamically to make sure that we keep reasonable cost through all the positions. So it's kind of a similar concept in a way. So I just like to kind of connect that. So yeah, it'll totally depend on the type of account. And in fact, having an account where taxes are important will inform a lot of how it gets crafted in the first place. Though one thing I am noticing a lot, and one thing I do want to mention is a lot of, accountants and friends and people in the news, they're all going to tell you that you really should be holding municipal bonds. For most of you, it's not actually going to mathematically shake out. I did an analysis. We were looking at all of our top tier clients. We were just kind of going through layer by layer. So I looked at all of the clients who had big accounts and they had these big taxable accounts. And I had our admin staff give me the best estimate I could of people who have provided their marginal tax rate, what they tend to withhold, all this kind of stuff so I could compare their taxes. Then I had an AI model help me run a simulation for all of the different tax brackets, comparing municipal bonds and ultra short bonds of very similar categories. So I used two funds, JPST and JMST, just to represent taxable and non-taxable. And I put them together. And for both married and single spouses, the only tax brackets that really benefited from tax-free municipal income was the 32% and above brackets. So if you're in 24% or lower, pretty much it's not gonna, yeah, for taxes, for your marginal tax rate, because bond interest is always taxed at ordinary income. You don't get that long-term capital gains. Now, of course, when we're talking about reallocating, it's important to note whether we have long-term capital gains or short-term. So if we've held an asset for 365 days or less, and there's a gain on it, and we sell it, we're gonna pay our normal tax rate as if we earned that dollar at a job, or we got it interest from a bond. But if we held it for 366 days or more, we'll pay a qualified rate of 0, 15, or 20. Or if you have a lot of income, it could be all the way up to 23.8. So that definitely does influence things. And that's why I tend to use more very broad-based index things that just, I don't want to have a bunch of little tiny sectors that are like going up and down all the time where I need to shift and in and out. I want very simple stock allocations, usually total stock market index funds, and then maybe like an international fund, but keeping the stock stuff simple and then really working with the income portion. So trying to get stuff like qualified dividends, so it gets taxed at 15, working with things like high yield bonds, so the interest is high enough, so even when we pay the taxes, it's still worthwhile, or using municipal bonds if the tax rate's high enough. So yeah, taxable accounts are where I actually do a decent amount more work to make sure that it's not a big impact. And there's also, of course, some people just don't want to deal with the tax burden of income from their portfolio. Like, it doesn't hit my bank account. I don't want to pay taxes on that. So there is a psychological part to it too, but yeah, so there are a bunch of different considerations that come in when it comes to that. We will have a bit more of a conversation about that later once we dive into some more tax related stuff. But yes, great question.
What?
She's still in business. She's still doing her thing, as far as I know. I mean, she's still investing in these ARC funds. So she's out there. I'm sure we can go follow her, but I don't do much to follow individual fund managers because I don't want to get too confused by all the stuff that they're talking about. So here we can see another chart that sort of represents up at the top. Here's that ARC Innovation ETF again. And then down here at the bottom, this is Tesla's price chart, right? Or return chart rather. So you can see a striking similarity around this area where the upwards chart on the purple line looks shockingly similar to the upwards chart on the orange line. And then the downturn looks shockingly similar to the downturn here. And you can see that it just comes right back down, right about this bottom here. They decide that maybe we shouldn't hold so much Tesla. And then what do immediately afterwards? It goes flying upwards. So, it was a gamble that paid off for a little bit, but they obviously have not been able to replicate the same sort of returns. You can see sort of the lack of consistency in these two areas is sort of the most important, where it's not really like that volatility that investing is just not paying off. Now, if morally, like, you're super into everything that they're doing, go for it. Just understand what the trade-off is going to be. So it's important to kind of, understand that human element as well and understand if it's something that you want, go for it, but understand what you're trading off. So next we're going to talk about something called R squared. R squared is one that also, this is like one of the hardest ones to explain sometimes, but the idea is R squared is a percentage of a fund or securities price movements that can be explained by movements in a benchmark. So it's like, okay, I have this stock and it went up by 30%. So how much of that was due to the stock being more valuable inherently, or did the market really just have a big up day? Because if the market just had a big up day and it happened to influence this because it was included in an index, then I can't really say that that's some extra return. So an R squared of 100% means that every single movement of a security is completely explained by movements in a benchmark. So think, for example, if I have an index fund and then I have the index, the R squared of that index fund is going to be 100% because everything that's happening in that fund is explained by everything that's happening in the index that it's recreating. So you can use this to gauge how similar our investment is to the comparable index, and it can be particularly useful in determining if there's value in high fee funds that invest in a common sector of the market. So if you are looking at a stock fund, a fund that picks stocks, and you're comparing it to the S&P, let's say its job is to also pick large stocks. If it has a low R squared, that means that it's moving in different ways than the S&P. The S&P is doing things that are not necessarily affecting it. If it's like 70%, you could have something that's called tracking error. So if the fund is not tracking the S&P at a super accurate level, it's doing different things, but it's returning more. If it's got a low R squared and a high alpha, that might be a really good management team that's doing a fantastic job at doing different things than the S&P 500, but returning higher. It's not a very common story because, as we saw before, 9 out of 10 managed funds tend to underperform the S&P, but these are some of the things that you can use if that's what you're looking for. So basically, R squared is just the unexplained variation divided by the total variation, and you subtract that from 1. Those get a little bit more complicated, but we're going to do the same thing that we did with beta. We're going to look at 3 slides comparing the S&P 500 and one of our ETFs, and we're going to display how R squared can be seen on a chart. It's going to be a little bit harder to think about when it comes in comparison to beta, but the S&P 500 will be represented by the purple chart, comparing ETF in yellow or orange, And together we'll look at these and try and see if an investment has a strong or weak R squared. And again, this will be the same 5-year period. Next. So we're looking at the S&P 500 in purple and the Vanguard Total Stock Market Index Fund in orange. How many of us think we have a high R squared here? Like how similar are these performance? Okay, you got 2, 3, 4, yeah. Now, a couple people thinking we have a high R squared here. How many people think it's lower, like a weak R squared, not super similar? Okay, you'd be right. Because the R squared of the total stock market ETF is 98.97%. Well, it's high. Yeah. So anything above 70 is considered high. It's considered strong. Although like when I think of like really strong, I'm thinking like 85% or higher. Lower than that, it really is is starting to deviate a little bit. But again, it's because if we were to look at the total stock market and the S&P 500 side by side, the top 500 holdings and approximately 95% of the value of the holdings are going to be exactly what's in the S&P 500 because those are the biggest by value, by weight. It's going to be pretty much the same. Then there's just that little bit of extra, the small cap and the mid cap companies that are going to make up for that approximately 1% of variation. So it's very similar. Now we're looking at two funds. And I want to know S&P 500 is in purple, our ETF is in orange, and I want to ask how many people think we've got a high R squared, like a strong R squared, very similar returns? No. How many people think we got a weak R squared? Yeah, okay. So you would be right. The R squared of the energy index fund, when you compare it to the S&P 500, is 20.97%, meaning that the energy index fund over this 5-year period performed wildly differently, and most of the movement was not due to anything that happened in the S&P. Because the energy funds, they're more sensitive to things like oil price changes, like natural gas, companies like that. That's more of a commodity-based volatility, which is not always reflected in stock market indices. Yes?
Mean whether your beta is improved in performance or even or under.
Kind of, yes. So
That well below still be a low R squared.
right, exactly.
Consistent with
Exactly. Yeah, because it's not about like which direction it went. It's like, did it go the same direction at the same time, same amount? You know, it's more about like how similar do the lines look to each other rather than whether it went further up or further down. Yes, exactly.
Are all these indicators used on the S&P 500 as the standard?
Right now, yes. Yes. So the question was if we're using the S&P 500 as our benchmark for all of this. And right now, yes, we are. Run over Mike Boy.
all used in terms of evaluating risk.
Yeah, so essentially it is a risk measurement, but really it's like when you're comparing an R squared to something, the higher the R squared is to whatever you're comparing it to, the more useful beta is. So for example, right here, if I'm comparing this energy ETF to the S&P 500, the returns are very different. So yes, the beta is high on there, but it's like I'm not going to experience that when the S&P moves a certain way, that the multiplier, I'm going to experience exactly that multiplier. Versus if it was something like a growth fund versus the S&P, I might actually, if it goes 5, I might feel 7. But if it's energy, it might go up 5. I might be down 30% because something completely unrelated happened. So beta becomes less useful to gauge like short-term risk if the R squared is really low. So it's like kind of the R squared is validating, is this index a good comparison? So it helps us to use those other metrics as a baseline.
Are they related to non-correlated negative correlations?
Yes. So well, yes and no. It's not the same thing. It's a similar sort of basket of things. When we talk about correlation, we're talking about, are the movements similar? So if you have a low squared, it's a chance that your correlation is closer to like 0, like it's not correlated. versus negative correlation is actually the idea that it is correlated in the opposite direction. So the idea is that if this asset goes up, this one will go down. That's negative correlation. Then positive correlation is just if this one goes up, does this one go up too? If it's a high correlation, it means it's more often than not that they will go in the same direction. But yeah, again, somewhat similar of a concept, slight differences. Okay, so we showed energy index ETF, and now we're going to go to another one. So now we've got our S&P 500 in purple, and we've got our index fund in orange. So do we think we has a relatively strong R squared? Yeah, seeing some yeses, seeing some confusion. Okay. Anybody think we have a pretty weak R squared on this investment? And it's good that you're a little like, yeah, it was strong, but it wasn't perfect. And that's right, because it was about an 88.52%. So it's good. That means that we can still use beta as our measurement. If the R squared's over 70, it's still useful to use beta to think of like, okay, on a year-to-year basis, I will probably have the same level of risk as beta suggests because our R squared is still strong. So really, R squared just, it verifies that beta and alpha can be used.
Is verification of a decision maker without on beta.
Yes. Exactly. Yeah. So R squared tells you how much of the variance of a security's returns can be explained by the index you're comparing it to. And R squared above 70 is considered strong. We would expect an index fund to have a very high R squared, pretty much 100% or 99% or 99.9. So the higher R squared, the more useful beta is as a measurement of risk. With a weak or low R squared, it becomes more useful to use standard deviation, which is just a raw measurement of volatility. So remember that the index you compare to determines the validity of these relative risk measurements. If we compared VDE, the energy index fund from Vanguard, to an energy index, well, the R squared would be super strong. And then beta and alpha would be very useful because they would be confirmed by that R squared being high. So these statistics need context. Not every single investment fits into well understood categories like small cap value or energy sector or healthcare or large cap growth. So we also need isolated measurements. Now, I want to say we are at time. So if you want to get out of here now, or we can go a little bit more quickly through some of these. What are you thinking? You want to see a couple more? We want to do a couple more? Okay, I'm seeing some nods. All right. If you want to leave now, class is actually officially over, but we'll just kind of roll through some of these next ones for the people who want to stay. So on a Morningstar report, we've got a couple here. We've got 3 measurements. One is called mean return, which is the expected value or mean of all the likely returns of investments comprising a portfolio. So essentially the idea is that we are looking at all of the historical data that we have. Thanks for coming. All of the historical data we have, and we're using sort of probability and statistical analysis to think, what's the likely giant group of returns that we could have? And so we kind of average those together and think, okay, this is the expected return. So the expected return for something like the S&P 500 might be 10 or 12%, which is that average return that we've measured over all of these different periods. And what we use this expected return for, that's kind of like our centerpiece. That's where we start from. So we use all of this historical data to calculate what is the most statistically probable return for us to have in any 1, 3, 5, 10-year period. And then we use that as sort of our anchor. And then around that is where we're going to measure standard deviation, which is essentially like what is the reasonable dispersion that we're going to have around that expected average. How far are we likely going to go? On one standard deviation, it's about 67% of the time. 2 standard deviations, it's like 80 something. No, 95, and then 3 standard deviations is 99. Okay, there we go. I got my guy to verify me on that one. And so Sharpe ratio, you could think of this basically as like alpha. except we don't have beta to use, right? Because we're not comparing it to anything. So what we use instead is we use standard deviation. So we use standard deviation to measure the risk instead of alpha. And then we say, based on how much risk we took with this measurement, how much excess return did we get? Very similar thing. So again, mean return, expected value, or average of all the likely returns of an investment in the portfolio, taking all the historical data, whether it be by day, month, or year. But outliers can significantly skew the mean return, especially if the data set is small. So if you're only measuring on 1 year, that might be a way different mean return that you're working with. Or if you don't have very much information, if the stock has only existed for 3 months, you probably are not going to have a very good idea of what it's going to do in a 15-year period. So expected return so obviously the mean return is not a guarantee, but it is the basis for measuring standard deviation. Again, standard deviation just kind of measures what's that channel that we expect most returns to lie in, but returns will still fall outside of that range. There's most returns will fall in the first and the second standard deviation, and then there's going to be some that sprinkle on the outside. Like we'll have 2008 crisis every once in a while, which is not part of the first standard deviation channel, but it happens. So this measurement gives us an idea of the overall volatility of any given investment. And this is pretty much just how that's shown graphically. So this right here is one standard deviation, about 68.2%. Okay, I was close. And then you have the second standard deviation. So that's almost all of the returns. You step out to the third, you get pretty much everything except for 0.2%. And that's kind of like, if you hear an investment has a standard deviation of 15%, they're talking about the first standard deviation. This one in here, the 68% probability, there's a 68% probability that it will return 15% higher or lower than the average expected return, right? So if I'm looking at S&P 500, if I assume that its expected return is 10% and has a standard deviation of 15, I can reasonably expect in 68% of scenarios that it's going to return up to 25% all the way down to -5%. That's sort of my channel that I can reasonably expect 7 out of 10 times. And it's just that blown up a little bit. Sharp ratio, again, is basically the same calculation as alpha is, but just instead of using beta for our risk our risk measurement, we use standard deviation. So we're not comparing to anything. It's just for the level of volatility, am I getting a good return? Pretty much is it. I like using this a lot when I'm looking at different portfolios. Yeah, when I'm yeah. And so alpha can be really good, but sharp is like, so alpha is good when you want to compare it to something else. Like if I'm replacing like a dividend fund, then I want to see how did this dividend fund do with the same level of risk as this one. But if I'm looking at, let's say, just like I just want to see a fund on its own, like a fixed income fund or something, and I say, okay, for the level of volatility that it took on, regardless of whatever else is happening, how much extra return did I get? Or was it not any extra? Was it less? So similar to alpha, but it uses standard deviation as a measurement of risk, and it's not relative. So we don't need a benchmark for this. Now, one extra one that I like that I've been using a bit more recently is called value at risk. This calculates the potential loss of investment within a given time frame, and it gives a confidence level. So, for example, you might have a security that has a 5% daily value at risk all time of 4%. What that essentially means is there's a 95% confidence, the opposite of the 5, that the security will not have a larger loss than 4% right here in a single day. And this metric, since this metric says all, we're calculating this using all available price history. So using all of the price history that we have a 95% confidence rate that in a single day, it's not going to lose more than 4%. Of course, days are still going to step outside of that, and they're still going to happen. But it's just kind of like, again, it's kind of like a fancier way of saying standard deviation with like a little bit more specific of a measurement. In another example, if a security has a monthly value at risk 1%, 3-year look back of 15%, there's a 99% confidence, 1%, that the security will not have a larger loss than 15% in 1 month using historical data from 3 years, right? Okay, so again, it's just kind of like if you took standard deviation and you got zoomed in on it. I kind of like using that because it's a good way, especially if you're looking at an entire portfolio, kind of gives you an idea of what sort of monthly fluctuations, daily fluctuations, yearly fluctuations you can experience with your basket. It makes you kind of like, okay, now I know what to expect, and that is a little bit more reasonable. There's another one that I'm learning about and using a bit more, which is called the Sortino ratio. It's named after Frank Sortino, who is widely recognized for his use of downside risk. So standard deviation measures risk both on the upside and on the downside. Upside moves is still risk. Downside is risk as well. It's all about volatility. How violently do we swing? So the Sortino ratio is very similar to Sharpe, very similar calculation in that it's trying to capture the risk of the investment over a certain period. However, the key difference is the Sortino ignores the upside volatility, focuses only on downside volatility, on drawdown, on periods of negative returns. And it says, okay, if we ignore the upside based on the level of downside that we have to experience while holding this, how much extra return am I getting? So it's basically just going, okay, Sharpe ratio looks at all of the standard deviation. It says based on all of that volatility, how much excess am I getting? And then Sortino goes, we don't really care about upside. Downside risk is what people care about. Nobody cares like how much risk they're taking when they make money. They care about how much risk they're taking when they lose money. So it just kind of chops that in half and use that to measure the sort of relative return for the level of downside risk. A higher Sortino is better because it reflects more return per measurement of downside risk. So if your Sortino is higher, it's likely that if it has bigger drawdown periods, it's going to pay off better, or it has in the past, basically. There's 2 bond-related metrics that we like to use. There's also average credit quality, which there's actually a handout when it comes to credit quality. We handed out this SEC brochure about credit ratings. So if you're interested in those, check that out. But these are the 2 things that I look at most often. Yes, credit quality is a bit important, but once you kind of get that, it's pretty easy. But average effective maturity pretty much is when you're looking at a bond is kind of like a contract because you have a certain time at which the principal is going to come back. You give them the $1,000 and they say in 2030 or 10 years or whatever it is, I'm going to give you your money back. And in the meantime, I'll pay you interest, or if it's a 0 coupon bond, you have that deal, whatever. If essentially average effective maturity just looks at all of the bonds in the portfolio, including things like if there's a call, if there's an option to call the bond, a bond seller may put the ability to call the bond back and buy it back from you early, so that if rates go down by a lot and you're getting paid 5%, but they could sell a new bond for 3%, they're going to go, hey, I'm going to go ahead and buy that back from you really quick. I don't want to keep paying you 5%. You'll usually make a little bit of premium on top of that. Not going to equal if you had held it the whole time, but they're going, I'm going to take that back so I can go reissue a new bond. So including that, including all of the different maturities of the bonds, it gives you an average effective maturity for the fund or the portfolio, which basically is just how long do all the bonds in my portfolio last? Now that's good to know, but then we go to average effective duration, which is essentially taking that information and then now we're going to include what interest is being paid on those bonds. So I like to think of it this way. Average effective maturity is how long the bond lasts, and average effective duration is essentially how long it takes you to get paid back your money, including interest. So think of it this way. If I sell a bond at $1,000, right, and I'm getting paid 5% interest per year, I'm going to get back my $1,000 maybe at the end of 10 years, but in that first year, I'm going to get $5. Now I only need to get $995 back to be back at 1,000. Wait another year. Now I only need $990, $985, $980. So technically, those interest payments are sort of artificially shortening the maturity length of that bond. So it kind of takes less time for me to get my $1,000 principal back. So duration essentially is just saying, take all those effective maturities, but factor in the income payments that are coming in as well. And what this then ends up giving us is the measure of the interest rate sensitivity of the investment of the portfolio. So you can forget about what the calculation is, but just know that if you see a duration of 5, if interest rates drop by 5%, pretty likely that that portfolio bond or portfolio of bonds is going to rise by 5%. So it's just kind of a relative sensitivity of the portfolio's value to interest rates. Because as interest rates change, the value of the bonds change. I'm not going to pay you the same $1,000 for a bond paying 1% when I could pay $1,000 to get a bond that pays 5. I'm going to pay you a relative value that makes it feel like I'm getting 5%, right? I'm not going to just go pay that the same price. It's the same way as like, I'm not going to go pay the same price for a 10-year-old version of my car as if I were to go buy a brand new one, because it's got all these new features that like I'm going to have to pay a relatively low price in order for me to compensate for the things I don't have. Here's credit rating, which is pretty much an independent assessment of a company's or government entity's creditworthiness with respect to a particular debt or financial obligation. Pretty much what you really got to know is everything above BBB and above, that's considered investment grade, which is pretty much like a kind of a word for safe, but it's just companies that are really good for paying back their debts on time and pretty much don't really default on bonds for the most part. They may have AAAs are like very safe, and government bonds, US government bonds always get a AAA rating. If there was a quadruple A rating, they would give it to them. Everything below this line here, so double Bs all the way down to D, which is in default. I would prefer to avoid bonds that are currently defaulting. All of this is considered junk, as I like to call them high yield, because they have to pay much higher interest rates for people to loan them money. For the most part, high yield bonds actually compensate you for that risk really well, especially if you're diversified across investments. So they are worthwhile to check out if you want to increase your income by a little bit. Just understand what the risks are there. Couple additional things right as we wrap up. Yeah, this will be our last one. So you've got your 12-month yield or dividend yield, which is basically the sum of all the income distributions from the previous 12 months divided by the last month's ending value. So you just think of it as like all the income that's been paid out for the last 12 months, divide that by the account value, it'll give you a 2%, 3%, or 4% yield. So when you hear yield, it's how much income related to what the price currently is. That's why you'll have a bond, it may have a coupon of 5%, but a yield of 3%, because that 5% is not, it's less proportionally of the price of the bond because people are paying more for it. So if the bond was released at a 5% coupon, but now you can only get 3% on a new bond, people are going to pay proportionally enough to where when you buy it, that 5% effectively feels like a 3% coupon, which will have a 3% yield while still having a 5% coupon, because the coupon is based on the principal value. Potential capital gains exposure is pretty much just estimating how much inside of the fund has unrealized gains. This is mostly a concern for mutual funds, especially in taxable accounts, because the idea is if they're buying and selling stuff, maybe they have these stocks that they've bought and held for a while, big capital gains, 30% of the portfolio has unrealized gains, and at the end of the year, they might sell those, distribute them out, and now you get to pay taxes on them. So this is kind of a way to see, okay, which of my mutual funds or ETFs are actually sitting on a bunch of gains inside there, and may they sell and distribute those back out to me. Again, only really a concern for non-qualified retirement or for non-qualified accounts, not for retirement accounts. A negative percent indicates capital losses, which usually they'll use to offset gains in the future. Now I know that was a lot, so do we have any questions before we get out of here? All right. Well, thank you guys for staying late. I appreciate it. That was really good. And we'll see you guys next week.